Hello friends, can you hear my voice? Can you hear my voice, guys? Fine, guys. So I can see that people are able to hear my voice. So we will start this session. So as you know, we have been conducting live sessions for ESI and finance on a regular basis. So basically, let me stop this first. So basically, the idea is to help you to prepare for these exams, give you direction, right? So today's session is basically on finance and management, and this we would be discussing about some guidelines and FAQs from RBI on money market instruments. And this session would be useful for RBI Grade B 2019 and SEBI Grade A 2019 because your money market instruments, that is your capital markets, which are short-term markets, which comes under money markets, are part of your RBI Grade B and SEBI Grade A syllabus. Well, just to inform you about our results, very excellent results over the past 2 years. In 2017, we have 27 final selections in RBI Grade B 2017 and 11 selections in NABARD Grade A. And in 2018, it has been a wonderful year with 26 selections in NABARD Grade A 2018 out of 46, which is a very good number, and 287 plus interview calls for RBI Grade B 2018 and 120 plus interview calls for SEBI Grade A 2018. The result for SEBI has been announced recently. These are our courses, individual courses. If you are interested for RBI and NABARD, you can buy these courses. And then we have combo courses for SEBI, RBI, NABARD, or RBI, NABARD, or SEBI or RBI. You can enroll into any of these combo courses in case you are planning to prepare for one or more of these exams. And the upcoming courses is one of our course for quant reasoning in English, because this component is important for almost all the banking exams, be it RBI, NABARD, SEBI. This is important for phase 1. And when it comes to SBI PO, IBS PO, RRB PO, or SBI, IBPS, RRB clerical exams, or for maybe RBI or NABARD assistant, LIC exams, any exam you take in banking sector, quant reasoning English is part of that exam. So this is our upcoming course, which shall be launched very recently, and this shall be a very comprehensive course and shall be useful for all the banking exams. Now let's start with the session without any more gyan on what we are offering. Well, the first question that comes to our mind is, because our session is on guidelines on RBI, guidelines by RBI on money market instruments. So the first question that comes to mind is, what is a money market, right? So basically we know that that is one of the component through which company can raise money, or maybe if not the company, even banks these days are raising money. A debt can be a long-term debt or a short-term debt. A short-term debt is called a money market. Basically, the debt for which the duration is less than 1 year comes under money market, right? Suppose you buy a government security for which the maturity date is less than 1 year, that would be called the short-term debt or money market instrument, right? So money market instruments are kind of debt instruments, but their maturity period is lesser than 1 year. Therefore, they are also called short-term debt. and these are the debt instruments which are both long term or they are short term money market instruments. We are not going to cover all these in this video or in this live session because then it will go for a very long time. Basically what we are going to stress upon here is commercial paper, then your certificate of deposit, then your call money notice market and NCDs, right? So these are the four components under money markets that basically I would be discussing in this live session, and we would be doing lot of questions from what we study in this live session so that you get a confidence that whatever I am teaching you, you are able to understand and apply at the same time. Now, many of the guidelines or FAQs that I am going to discuss with you in this session, maybe 60-70% of them have already been discussed in the paid courses, right? New things that we would be discussing would be non-convertible debentures, that is NCDs, and some limitations on borrowing and lending in call notice money market. These two things have not been discussed in your paid course also, but this video after the live session will go into the live course also under RBI FAQs. So first important thing to know is that what is the most important feature of money market which differentiates it from another markets. So as I told you, money market is basically for short-term debt, right? Therefore, the most important feature of money market is liquidity, that you can quickly convert your funds into cash if the need arises. This is the most important part of the money market, or you can say money market instruments, right guys? Now let's start with call notice money market. As I told you, we would be discussing about four instruments here: call notice money market instruments, CODs, commercial papers and NCDs. So the first one I am going to discuss with you is call notice money market. Now what is call notice money market? Basically when banks borrow from one another, like suppose this is a bank which borrows money from this bank, this is another bank, it comes under call money notice market, right? Now why do banks require to borrow money from call market or notice market? The reason is that banks are required to maintain some amount so as to they fulfill the cash reserve ratio requirement as mandated by RBI. So sometimes they are loss on cash because they have to keep huge amount of cash which gets you can say that which is not available to be lent to the general public because that is used to maintain their cash reserve ratio. Therefore to meet their additional requirements of cash, banks borrow money from call market or notice market, right? And this interbank borrowing of banks to have additional cash at their disposal has led to the development of call market or notice market. Now what are the borrowing and lending restrictions in the call notice market? This is a very important part, and another important part to know is that what are the participants in call notice market. As I told you, mainly the call notice market is for banks. Banks lend or borrow from one another. So the participants are scheduled commercial banks, cooperative banks, and primary dealers have been also allowed to be part of call notice market. And the most important point that you should remember, which is a very important development, is that payment and small finance banks, they have also been allowed to participate in call notice market, right? This is a very important development which has happened in 2018. So this might be asked in your exam that which all banks can participate in call notice market, or can payment and small finance banks participate in call notice market? So this is very important point to remember, that yes, payment and small finance banks can participate in call notice market. Now let's discuss the various borrowing and lending restrictions for all these participants in call notice market. For scheduled commercial banks, what are the restrictions with respect to borrowing? So basically, if we calculate the average for 15 days, because this data is reported on a fortnightly basis, if we calculate the amount they have borrowed and we calculate it as an average for the 15 days, then the amount they are borrowing should not exceed 100% of the capital funds. Capital funds means your shareholder equity plus your debt, right? So basically, on an average, for a single day, they should not be borrowing more than 100% of their capital funds, and capital funds is basically your shareholder equity plus debt in a simple terms, though this is a very complicated term, but we need not go into that, right? So this is on average basis for 15 days because this is calculated every fortnight. But otherwise, if we neglect the average, in a single day also they can borrow maximum of 125% of their capital funds, right? Suppose on average basis they do not do anything for first 14 days, and then it does not mean that on the 15th day they can borrow huge amount of money. On any single day, they should not borrow more than 125% of their capital funds, and on a daily average basis for 15 days their borrowing should not exceed more than 100% of the capital funds. And with respect to lending, if we calculate the lending again on a daily average basis for 15 days, their lending outstanding should not be more than 25% of their capital funds, and the maximum limit for a day is 50% of their capital funds, right? Again, here if we are saying that daily average calculated for a 15-day period, then it should not exceed more than 25% of their capital funds. But that does not mean that we have to always calculate the average and on daily basis or on a particular single day they can lend any amount of money. No, for any single day also they cannot lend more than 50% of their capital funds. Otherwise, for a 15-day period, the average should not be more than 25% of their capital funds. This is for scheduled commercial banks. This is not tough, guys. You might be finding it tough right now, but just try to have these numbers in your mind. That shall be sufficient. Then we'll come to cooperative banks. For cooperative banks, there is no daily limit, but there is no average number for a 15-day period, but on daily basis they should not borrow more than 2% of their aggregate deposits for the previous financial year. So if we are in 2019 May, then up to March 31st, what were their aggregate deposits? That is in the previous financial year. 31st March comes under previous financial year. So till 31st March, whatever was their aggregate deposits, that the money which people have deposited with that bank, they cannot borrow more than 2% of their aggregate deposits for the previous financial year as at the end of March on any given day or on a daily basis. For lending, there is no limit. They can lend any percentage of their aggregate deposits. Then we come to primary dealers. Now, primary dealers are allowed to borrow on daily average basis. So this is that for a 15-day period, their daily average should be up to 25% of their net owned funds. What is net owned funds? Your shareholder equity basically. Capital fund is shareholder equity plus your debt or liabilities. Net owned fund is basically your shareholder equity. So primary dealers, their condition is that for a 15-day period, their daily average should not be more than 225% of their net owned funds. And with respect to lending, again it is not calculated daily, but on a daily average basis for a 15-day period, their lending should not be more than 25% of their net owned funds, right? So these numbers you have to remember: 100, 125, 25 on average basis for 15 days, 50 days on daily basis, 2% on daily basis of aggregate deposits, no limit on lending, and for PDs 225% as an daily average basis of their net owned funds, and lending it should be 25% on daily average basis for 15 days of their net owned funds. And for payment and small finance banks, the conditions which we have studied in scheduled commercial banks, the same conditions will apply for payment and small finance banks. Now let's do some questions to check whether you have understood the last slide in case you are having any difficulty in that. Up to what percent of their NOF can PDs lend on average daily basis in overnight reporting in the call notice money market? Tell me. I have just explained you that what is the condition with respect to lending on PDs, that this is calculated on average daily basis for a 15-day period, and the maximum percentage that they can lend is 25%, right? So the answer is A. Here I have explained you, right? So the answer is A, here 25%. Next question. This is a very simple question, guys. You must be knowing the answer of this. Who all are eligible to participate in call notice market? Scheduled commercial banks, cooperative banks, small finance banks, payment banks, or all the above? The answer is all the above. I just explained you that who all can participate in the call notice market. Earlier it used to be scheduled commercial banks, cooperative banks, but now they have added small finance banks and payment banks also. So your answer is all the above, that is E. Coming to the next question. Scheduled commercial banks are allowed to borrow a maximum of -% of their capital funds on any day during a fortnight. That scheduled commercial banks are allowed to borrow a maximum of what percent of their capital funds on any day during a fortnight? Tell me, guys. In case you have forgotten, just try to remember what I explained here, right? Here we have told you that on an average daily basis, for a 15-day period, it should not exceed 15%, but on any given day, it should not be more than 125% of their capital funds. So the answer here would be 125%. That is option number C. Maximum 125% of their capital funds can be lent on any given day, but on an average basis, it should not be more than 100%, and that average should be for a period of 15 days. Now we move to commercial paper. So I have explained you about call notice market. Now I'll explain you about commercial paper. So what is commercial paper? Basically, companies wants to raise money for a short term period, because suppose company is in profit, but there is so much money which is with the buyers of the products of the company, which will come to them later, right? Because many a times we give products to our buyers and we take money from them later, like we are giving products on credit, right? Hindi mein we say it is an udhar. So many companies require working capital or short term money because they don't have cash to run their operations, though they are profitable. So commercial paper is one such instrument that can be used by companies basically to raise money. It doesn't mean they are into loss. They are raising money because their money which they have earned from profit is actually lying with the customers who will pay it later, right? But commercial papers are unsecured. If some company is raising money through commercial paper, and if you have bought a commercial paper of that company and you have given money to that company because you have bought the commercial paper of that company, that is unsecured. Unsecured means there is no guarantee that your money will come back. Company does not have any collateral with respect to that which can be used to recover your money in case company refuses to give your money back, or company suffers some losses in future due to which it cannot give you your money back. And they are usually issued at discount. At discount means, suppose the value of commercial paper is 100, then they will issue you at 80, and at the maturity they will give you 100 rupees back. So you bought it in 80, but at the maturity when you gave back your commercial paper and redeemed it, you will get 100 back. So that 20 is kind of interest that you will earn on that commercial paper. So this will be like a zero coupon bond, right? And earlier the commercial papers were only allowed to be issued by companies, but later they were allowed to be issued by primary dealers and some financial institutions. Now, who all are eligible to issue commercial papers? As I told you, companies, primary dealers and financial institutions are permitted to raise money through CPs. The money raised is basically used to meet short-term capital requirements or working capital. Mainly it is the companies who use the commercial paper to raise money, but primary dealers and financial institutions can also raise money using commercial paper. And a company would be eligible to issue CP, that is commercial paper, only if these conditions are met. First is that the tangible net worth of the company should at least be 4 crores, right? And the company, that is the borrowing account or the bank account of company which is used to borrow money, should not be tagged as an NPA. It should be a standard asset. This is very important. If that account is tagged as an NPA, then company is not eligible to issue commercial papers, right? And in the last slide we discussed about who all can issue commercial paper: companies, PDs and financial institutions. But who all can buy commercial papers, or who all can invest in commercial papers? So individuals like you and me can buy commercial papers, banking companies, other companies like corporate bodies registered or incorporated in India, then non-resident Indians, foreign institution investors. So almost everybody can invest in commercial paper, but the important point is that even NRIs and foreign institutional investors can invest in commercial paper. This is an important point to you for remembering. And other investment conditions for investing in CP: first of all, CPs, that is commercial papers, are issued in denomination of 5 lakh and after that in multiples thereof. So if you want to buy a commercial paper worth rupees 8 lakh, you cannot do it, because the minimum denomination is 5 lakh and after that the multiples are multiples of 5 lakh, 5, 10, 15, right? No issuer shall have issue of CP underwritten. Underwritten means that in IPOs, when companies issue equity, there is a concept of underwriting. So underwriter will guarantee that it will buy at least 90% of the shares of the company if people are not interested in that. But no such underwriting is allowed in issue of commercial paper. Just remember that. This is again important. And the maturity period is minimum of 7 days and maximum up to 1 year with respect to commercial paper, right? So this maturity period is also important to remember. There was recently a question in SEBI on this. Rating requirement for CP. So any company who wants to issue a commercial paper has to obtain a rating from a registered rating company which is registered with SEBI. This is very important so as to ensure that company who is issuing commercial paper is in good health. The minimum rating that shall be obtained by a company who is issuing CP is A3. Like A1 is very good, A2 is then mediocre, A3 is after A2, then A4, A5 are like bad ratings. So the minimum rating for a company to be eligible to issue CP is A3, and this rating shall be obtained by one of the credit rating agency registered with SEBI. Next is about buyback of CP. Can company buy back the commercial paper after it has issued? For example, companies can buy back the shares once they are issued. So can a company buy back the commercial paper once it is issued? The answer is yes. Company can buy back the commercial paper once it is issued, that is before maturity. But the important point is that it can only be bought back after 7 days have elapsed. So if you issue a commercial paper, say on 1st of January, you cannot buy back it before 7th of January. Minimum of 7 days has to elapse before you can make a move to buy back that. And for buyback of CPs, as obvious that approval of board of directors is mandatory, otherwise you cannot initiate the move to buyback of CP. Even in buyback of equity or shares, one has to take approval from board of directors. Let's do some questions. A company, PD or financial institution are eligible to issue CP. CP is an commercial paper in an unsecured term, short-term loan issued at a discount by the issuer. The minimum denomination of CP is. So basically the question is that what is the minimum denomination for which CP can be issued? I have explained it to you very clearly. I hope you are able to answer this question. Let's see who all can answer this. People are answering it as 5 and that is correct. The minimum denomination for which CP can be issued, the answer is 5 lakh. Next question. The maturity of commercial paper can be maximum up to how many years? So that is what is the maximum duration or maturity period or duration for which commercial paper can be issued to investors? Yes, the answer is 1. The maximum period for which commercial papers can be issued, the answer is 1 year. So now we have discussed about call notice market. We have also discussed about commercial paper. Now let's discuss about certificate of deposit. Now what is certificate of deposit? You have heard about fixed deposit when you go to a bank and you ask them that they shall make a FD out of your account and you will get a particular interest on that amount which you are depositing as fixed deposit. Similarly, a certificate of deposit is a time deposit with the bank where banks sell you a certificate of deposit and you give them money. Now what is the difference between certificate of deposit and FDs? Basically, once you have blocked your amount in an FD, you cannot sell that FD, you cannot transfer that FD to anyone. But certificates of deposits are like tradable instruments. Now you have given suppose 1 lakh to bank, they will give you a certificate of deposit that you have deposited 1 lakh with the bank. Now you can sell that certificate of deposit to any other person, you can transfer that certificate of deposit to any other person, and the person who will buy your certificate of deposit can further go to the bank and claim that money. Right, so this is the main difference. FDs are not tradable or transferable, whereas CDs, that is certificate of deposits, or CODs are transferable or tradable. Now who can issue certificate of deposit? Commercial papers could have been issued by companies, primary dealers or FIs, whereas certificate of deposits are mainly issued by commercial banks in India, and along with that even financial institutions like IFCI can also issue certificate of deposit. But the main purpose for which certificate of deposit are used is by commercial banks. They are the major entities who issue certificate of deposits to raise money. And please remember, when we say commercial banks, RRBs and local area banks does not come under the ones who can issue certificate of deposits. Now what is the aggregate amount for investment in CD? That till what amount banks can issue CDs? The answer is there is no limit for commercial banks. For financial institutions also there is no limit, that up to this amount only they can issue a CD, but overall there are regulations prescribed by RBI that financial institutions can raise this much money, so they should not breach those regulations. But as per se, there is no specific restriction on raising money through CDs for financial institutions. Now what is the minimum denominations for which CDs can be issued by banks or financial institutions? The answer is rupees 1 lakh. So remember, in commercial paper it was 5 lakh, whereas in CODs or certificate of deposit, it is only 1 lakh, and after 1 lakh in multiples of 1 lakh. So you can buy 1 lakh, 2 lakh, 3 lakh, 4 lakh, 5 lakh worth of CDs. Now, who are eligible to invest in CDs? Individual, corporations, companies, trusts, non-resident Indians. Important point to note here is that foreign institutional investors cannot invest in CDs as per RBI FAQs. And even NRIs who are investing in CDs, they cannot sell that in the secondary market, right? So they have to keep them till maturity. Those CDs are issued and they are transferable, but NRIs who are buying CDs cannot sell them in the secondary market. Please remember that. What is the maturity in CD? It depends. If the CD is issued by banks, then the maturity is same as we discussed in commercial paper, less than 7 days and not more than 1 year. But if CD is issued by financial institutions, then we have a different maturity period. It should not be less than 1 year and it should not exceed more than 3 years. Now the question that might be coming in your mind is that since money market is the one where instruments are issued for a shorter duration of lesser than 1 year, then why FIIs can issue CDs which have a maturity period up to 3 years? Well, that's an exception. I cannot explain that further, though they can still issue CDs which are less than 1 year. Therefore, these CDs issued by FIIs also come under money markets. The next question is loan or buybacks on CDs. Can banks give loan by exchanging those CDs? Suppose you have bought a CD from a bank, then can you use that CD as a collateral to get loan from another bank or the same bank? The answer is no. Banks cannot grant loans against CDs. And next is that banks cannot buy back their CDs. This is also a very important point. Banks cannot buy back their CDs, though commercial papers can be bought back by the company, but certificate of deposits cannot be bought back by the banks before the maturity period, except when there is some relaxation given by RBI, and RBI would give relaxation only when there is something very extreme. Now let's do some questions. Let's see who can answer all these questions. The first question is, which of the following statement is true? Who will answer this question first? Let's see. Well, the first statement is commercial paper is primarily issued by companies, whereas COD is primarily issued by banks. Is this correct? I have told you that commercial paper is primarily used by companies to raise short-term money, whereas certificate of deposits, here you can just remember that deposit is a word, so who basically does the fixed deposit is a bank. So therefore CODs are primarily issued by banks. First statement is correct and therefore this is the answer. Let's see who can answer the next question. Minimum denomination, here it's written wrong, denomination. So minimum denomination for commercial paper is greater by dash lakh as compared to minimum denomination of COD. Now this is a bit application related question. The question is that by how much the minimum denomination of commercial paper is greater than the minimum denomination of COD, that is certificate of deposit. Let's see who can answer this question. Avinesh Ranjan has answered it as 4 lakh. Very good. I can see some answers, some people answering it correctly. You are right. The minimum denomination for commercial paper is 5 lakh and for COD is 1 lakh. So for commercial paper, the minimum denomination is greater than 4 lakh as compared to the denomination or minimum denomination of COD. Let's go to next question. The CODs issued by financial institutions can have maximum maturity period of dash years. So basically we have discussed that the maturity period differs and depends upon whether the certificate of deposit are issued by banks or financial institutions. Now the question is that if CODs are issued by financial institutions, what can be the maximum maturity period? Very good. I can again see some people who are answering it correctly. The answer is 3 years, because if CODs are issued by financial institutions, the minimum is 1 year and maximum is 3 years. So we have discussed about call notice market, commercial paper, CODs. Now we will move to non-convertible debentures, which shall be the last part of our session today. So what are non-convertible debentures? Basically, when you issue bonds or when you raise money using bonds, and those bonds or debentures cannot be converted into equity later, those are called non-convertible debentures. The convertible ones would be where the bonds would get converted into equity. The non-convertible debentures are the ones where the bonds or debentures you have issued would not be converted into equity in future. So NCDs are the ones which are issued by corporate, and when we say corporate, we also mean non-banking finance companies like Bajaj Finserv, and they are issued using private placement. So they are not issued using some public offer or rights issue, they are issued using private placement. Now who can issue NCD? Here the conditions we discussed in commercial paper are similar to what we are going to discuss in non-convertible debentures. Now please remember that many of the things what we discussed in commercial paper are similar to what we would discuss in non-convertible debentures, and the reason is that since both are being issued by corporates or companies, so therefore there is some similarity between them, right? So the first condition is again that corporate who is issuing NCDs should have minimum tangible net worth of 4 crore rupees, and the account of that corporate who is issuing NCDs should be classified as standard asset and should not have been categorized as an NPA account. What is the ratings that need to be obtained by a company for issuing NCDs? First is the rating shall be mandatorily obtained by a credit rating agency who has registered with SEBI. The minimum rating shall be A2, only then the company can issue NCDs. And remember, in case of commercial paper the minimum rating was A3, whereas in case of NCD the minimum rating is A2. What are the other conditions for issuing NCDs? First is that their maturity should not be less than 90 days. In case of commercial paper it was 7 days, but in case of NCD it is minimum of 90 days. The minimum denomination is 5 lakh. This is same as case of commercial paper, and NCDs might be issued at a discount like a commercial paper, or they can be issued at a face value carrying a coupon rate, where it would not be issued at a discount but it would be issued at a face value and there would be certain coupon rate attached to those NCDs. And any company who wants to issue NCDs shall appoint a debenture trustee, and that debenture trustee who is being appointed by NCD should have registered with SEBI as per SEBI regulations for debenture trustee. And who all can invest in CDs? Again, what we discussed in case of commercial paper: individuals, primary dealers, corporate bodies, NRIs and FIs. So FIs cannot invest in certificate of deposit, but they can invest in commercial paper and NCDs. So let's do some 3-4 more questions. After that we shall close this session. The question is: minimum rating required for CP is dash and for NCD is dash. Very good, guys. The answer is B. The minimum rating required for CP is A3 and for NCD it is A2. Next question. NCDs are dash instruments issued using dash mode. So you have to tell whether they are debt instruments or preferred stock instruments, and they are issued using what mode? The public offer mode, rights issue mode, or a private placement mode? Very good, Anivesh. Ranjan, you are answering most of the questions correctly. I am happy that you are listening to this session very carefully. NCDs are basically debt instruments. They are not a preferred stock or equity. NCDs are debt instruments and they are issued using private placement mode. So the answer is option number C. Next question. Companies which wants to issue NCDs or commercial paper. So basically here it's both NCDs and commercial paper should have tangible worth not less than how many crores? Very good, guys. The correct answer is C. You are right. The companies which wants to issue NCDs or commercial paper should have tangible worth not less than 4 crores. Now tell me the question answer for this question. Which of the following instrument must be issued in a minimum denomination of 5 lakh? Your options are commercial paper, NCDs and CODs, and there is a combination of these in options A, O, A, B, C, D. Well, I have told you in the session that commercial papers can be issued in denomination of 5 lakh, that is a minimum denomination of 5 lakh. NCDs can be issued in a minimum denomination of 5 lakh and CODs can be issued in a minimum denomination of 1 lakh. So, the minimum denomination of 5 lakh is for commercial papers and NCDs, therefore the answer is A, 1 and 2. Let's go to the next question. Which of the following can have minimum maturity period and how much? So basically the question is that which of the following can have maturity period which is minimum among them, and what is that maturity period? Is it 7 days, 90 days, 210 days? What is that? Let's see, guys. Avinesh Ranjan, I am waiting for your answer. You have not answered this as the first one, though you are answering all other questions as the first student. So Anivesh Ranjan has answered it as 1. Mohit Garg has answered it as 1. Sahitya B, Aman Prakash, Swapnil Agarwal and has answered it as C. Mohit has also changed his answer from 1 to C. Well, though I have told you earlier that there are a lot of similarities between commercial paper and NCDs, but they are different in terms of minimum maturity period. For commercial paper, the minimum maturity period is 7 days and maximum is 1 year. For NCDs, the minimum maturity period is 90 days, and for CODs, if they are issued by bank, the minimum maturity period is 7 days and maximum is one year. So there is lot of similarity with respect to maturity period between commercial paper and CODs, as both of these can have minimum maturity period of 7 days. So your answer is option number C, that is 1 and 3, commercial paper and CODs, and by how much it is 7 days. Right, thank you guys. I hope the session was useful. There are a lot of questions asked on these instruments in the exams, may it be RBI grade B or SEBI grade A. Right? So that was a bouncer. Anivesh is saying that was meant to be because that was the last question to make you realize that everything is not right, Anivesh, though you are answering all the questions correctly. But still, there are some questions that you need to answer only after some deep thinking. Right? So guys, I can assure you that if an exam there is a question from CP, COD, NCD or call notice market, you will be able to attempt that. So the objective of these sessions is to make you understand the concepts comprehensively yet in easy manner. Right? And I love the way you answer because that makes the session interactive. And that's it, I think. And in case you have any query, you can call us at your number 8146207241, or you can email us at hello@edutab.co.in. And in case you want to join our courses, I will recommend that you join our combo courses for RBI SEBI, RBI NABARD or RBI NABARD SEBI. Those are really good in terms of exams they are covering. That will increase your chance to at least crack one of the exams. Thank you. Bye.